Well then, metals, and gold in particular, is once again at a crossroads on the verge of a reversal. You ready for this? In this video, I'll show you the latest updates on what's happening with gold and what potential trades we can squeeze out of this market. For your account, here's the global layout. It hasn't changed for 4 months now, and I show it time and time again. Globally, in metals and specifically in gold, we're in the development stage of Wave 4. And essentially, all of this is taking place within the shift pitchfork. A classic standard setup in a shift pitchfork usually tells us that upon a trendline breakout and the formation of a local correction, we can expect the first upward signals to form. And in order to align my global plan for further growth with the local structure, you and I are going to start from scratch right now. And I'll walk you through the entire logic and sequence of steps I use for my own personal analysis and trading. Here's gold on the 6-hour chart. This is the entire history since January when the asset was falling. And we'll try to figure out what's going on here. Now, for the most important part, look, we initially viewed the situation as the formation of a standard classic 3-wave move. But for our wave C to be completed, we needed to see a 5-wave move. That is, a classic 5-wave impulse within this structure. In the end, we only got a 3-part movement. Consequently, we can't call it a 5, we label it as ABC. But then the rules of wave analysis kick in, which state that our movement into wave C cannot consist of only 3 waves. This means we must structure and label it as a complex correction. If that's a bit unclear, just bear with me. I'll map it all out and explain how it should look. So the first stage, where we left off previously, and right when we didn't see a new low, was related to the formation of the shift pitchfork. So look, if a classic 5-wave impulse is forming, we should see a shift pitchfork and a 4th wave within that pitchfork. That is, there should have been a stop in the equilibrium channel, the middle of our channel. Or, in the case of a sharp enough decline, meaning a large difference between waves 3 and 1, we could have seen a move to the upper boundary. Accordingly, in that scenario, our next target would be at the median of our pitchfork. Thus, the limit of our correction was right here. As soon as we broke outside those limits, it became clear the downward cycle was over, and the only possible model is the one you see here. So a sort of vacuum occurs where the layout is unclear, but we're forced to monitor the asset based on the actual data. What does this mean? It means that our best tools for this period of time are volume zones and horizontal levels, which allow us to track and figure out exactly where we might come to a stop. Here's the first zone where we actually got, the so-called retests and further continuation. And here's the next one, which is exactly where we are right now. So from this level, it's quite easy to get a reversal and a return to the previous mark of 4,600. In case of a breakout, notice that the volumes are increasing further on, so it's essentially a solid zone, quite spread out, where we'll see a correction either way. Unfortunately, it's hard to predict, but the main takeaway here is that in this range of 4,800 to 5,100, we'll definitely get a correction, so it's better to wait it out. What happens next? Well, next, my friend, there are 2 scenarios that we need to consider. Let's go back to the global layout and say that in terms of meeting the minimum targets for the decline amplitude, we've hit 38%. So we've returned to the equilibrium channel, and at this point, we can actually start growing. But the problem is that the upward structure raises quite a few questions, and the only most likely layout I see here so far is the formation of a diagonal, in which we should have had one more decline, and only after that do we start growing. So in this case, the consolidation between the levels should continue. And if a triple like the one marked here forms, we can already talk about a potential trade to the upside. Say, on a breakout of the last high, that's 4,870. So that's the first scenario where we move further, and the next targets will be 5,800 to 6,500. This is just a draft for now, so just keep in mind what we'll be looking at later. But why do I say it's better to wait and see what the market specifically shows us? There's one single model that isn't accounted for here and might be realized later. It's a triple combination where we get the WXYXZ model. So roughly speaking, we're now seeing a correction that's shown like this on my main chart. So with two triple movements, we get the completion of this corrective part and head in a downward direction. What does this look like on the current chart? It means we'll return to our boundary again, which is the level of about 4,500. Do some consolidation here, and then we can continue the movement through a triple, as before. So overall, what can you and I do here? We can overlay this part onto the subsequent movement, and more or less expect the same component within Z, that is, within the next move. And our task right now isn't to guess the direction, but to eliminate the possibility of making our own mistakes in future trades. So here we're finishing the growth phase. Specifically, if anyone's in a trade, you need to start monitoring it and, if necessary, closing out at some point. Next, once the correction starts to form, the key level for us will be the volume zone, that is 4,567. Accordingly, if we get a reaction here, I'll draw an alternative scenario. Using red arrows, then on an upside breakout, we'll get confirmation of a reversal. And in this case, as soon as consolidation forms, the deeper correction scenario is canceled, as are any thoughts that a more complex combination is forming here, and so we move to the upside. On the way up, our only problem will be the range between $5,000 and $5,100. Accordingly, if we break through this zone, then we can start aggressively scaling into trades and planning positions. So right now, it's important to wait and see what happens in this area, what kind of pattern will form, and most importantly, which way the breakout occurs. The direction of the breakout can be used directly for a trade, either short or long. And the main thing to add at the end, my friend, is that lately I've been seeing a direct link between the S&P 500 index, oil, and gold. These three assets actually influence each other lately. And in my view, this part needs to be considered as a whole. So if you watched my previous video on oil, if not, definitely check it out. The likelihood of a triangle playing out and a new high will lead, for example, to a drop in gold. If, however, oil goes into a bearish scenario, that is the realization of a deeper correction pattern, then in gold, we'll get the red scenario I'm showing you here. So for now, in this video, I'm saying I'm taking a pause to wait for the next part that's gonna form. And active trades will come a bit later. Good luck to you. See you in the next video.